and welcome back to the first Arystocast of 2023. It's a new year, new me. I'm joined here by Purvance today, the MD of Arystocast Asset Management. Purvance, welcome.
Thank you.
I heard you traveling quite a bit since the back end of last year. You were in London.
Yes, I was in London.
You visited the Library of Mistakes in Edinburgh.
Yes, I might add with you. So you also.
Probably for those of us that don't know what the Library of Mistakes is, can you maybe just highlight, why did we go there? What was the purpose behind it? Did you get what you expected out of it? And would you go again?
That's a lovely question to start this conversation off with, team. I'll give a bit of background and try not to take too long with answering the question. But I used to live in the UK, and at the time I subscribed to the Money Week magazine, which is kind of the fun week of the UK. And while I was there, I came across quite a number of, let's call it, experts in certain categories. And at the time, I came across a gentleman named Russell Napier, a Scotsman that is basically a financial historian. He calls himself a financial historian, and he's quite recognized as a financial historian. And over the years, I started to follow him quite closely. And I think it was around 2014, after I had already come back to Namibia, he started this thing through a charitable organization called the Library of Mistakes. I only became aware of it around 2020, in fact, during the year of COVID. And there was a podcast or an interview where the discussion was around him establishing this Library of Mistakes and where it came from. And I found it fascinating. The name is obviously capturing. I'm sure people are now already thinking, wow, what is this thing called the Library of Mistakes? But essentially, this guy, as a financial historian, had kind of come to recognize certain patterns in the financial world, and these patterns seem to kind of repeat themselves. And if you understand them, if you track them and you understand them, you kind of have an ability to kind of make long kind of term predictions of events. And so the Library of Mistakes was really a library that stocked books, or that currently stocks books of, things like the greatest frauds in history, the greatest disasters, let's say bankruptcies in history, the greatest financial market calamities in history, and kind of books where experts and authors talk about how these events kind of unfolded and how they eventually came to the disaster or the mistake. And the idea is for us as human beings to learn about the mistakes of the past, to find out about them, and to help use them in your sort of daily life, whether it's investments or whether it's in your business. And so I always wanted to go since I found out about it. In 2020, we obviously had COVID, and that was a bit restrictive. And early in 2022, I heard another conversation about it, and I said to myself, this year's the year I'm going to go. And it's a very quaint library in Edinburgh in Scotland. In fact, the city where I lived in for about 3.5 years. And it was a great experience and more. I think you will remember that when we eventually had to leave the library, it was kind of a sad moment because we actually wanted to stay there quite a bit longer. It was kind of, for me, like a kid in a candy store kind of feeling. And I think I will definitely go back to that venue. If I could speak to Russell again, I would most definitely want to do that. And I think the experience for me, and I think for all of us, has been so powerful that, we've been thinking about, when you take it back to Namibia, how can we stimulate reading? How can we stimulate interest in financial markets? How can we stimulate interest in investments? And at which level should we start? I mean, we had a library in my school, in my high school. I don't remember there being any financial books in that library. A lot of books about Roald Dahl and, these kind of authors, but nothing really about investments and business and understanding money, I think. And I think we can, as a corporate social, initiative, we can do a lot in Namibia, learning from that Library of Mistakes experience.
Yeah, well, I think, it's also the engagement and the conversations that you can spark around that. Because even through our discussion with Russell, it's not just a public library for you to come sit down and read books. They have regular book reviews where they get experts from the
Absolutely.
And I think especially in the younger generation.
Yep.
So it's also about creating awareness around financial literacy and building that up in the community. So I think as an initiative, I would definitely support something like this. So back to the reason why we're acting. But I think it is important for us to highlight that. But here we are. It's Jan 2023. Last year, I actually don't remember a word to describe last year. But I've jotted down a few things of what transpired in markets across the globe. What are some of the key things that happened? So if you'll allow me, I'll quickly run through it. If you look at markets, I think we took quite a beating last year. The MSCI World Index was down over 17%. S&P 500 down over 80%. And the NASDAQ, I think, got hit the hardest, about 30% down. Inflation still running hot. The latest inflation print in the US just came out, about 2 weeks ago, starting at 6.5%. Obviously way above the levels that they are used to. For us, it may seem normal. We've seen constant rate hikes since the beginning of last year. Easy money has dried up. Russia and Ukraine war, I don't think it's anywhere near the end of that. We saw the China lockdown somewhat ease. That rally has been coming through since the back end of last year. The US-China tension is just intensifying. I think about just the whole ban of Huawei that we've been seeing. I was in Germany recently, and I struggled to find, as big as Germany is, so we were in Hamburg at that point in time, I struggled to find one store that was selling Huawei phones.
Is it banned in Germany, or is it?
So actually, remember, it's not banned like it is in the US. Germany actually came out a while back and said, they're not going to ban it. They're still going to make the phone available. But it's just the case of no one in Germany wants to buy the phone. And that's the message that all the stores are giving us. They don't have any customers that are looking for it because of the ban on Google and all these other apps that you can't use on Huawei anymore. So there's just no demand for it anymore. So no one is willing to stock the phone. Which I found quite interesting. Some of the other things that happened last year, former Japanese PM was assassinated.
Wow, forgot about that. That's so bad.
Liz Truss.
The one you can't trust.
That's the one you can't trust. But 2 months to. I was thinking, if you registered for CF in level 1 and you started studying, it was around about the same time that she took up a position in office.
Yes.
You would have probably still been, reading through your first chapter by the time that she read that. And then, of course, there was some sad news. There were a few prominent people that passed away last year. Queen Elizabeth, no longer with us. Pope Benedict is another one that I actually forgot about, and I saw that popped up last night while I was going through my notes. And Pele.
Yeah. And I still stand to be convinced that Pele is no longer the greatest footballer in the world because Messi and Argentina won the World Cup. But my expertise are not in football, even though I played it in school. But we don't have the time, right? But the question I have for you, I think this will have the listeners their mind will boggle on this one. The question is, why do some of these really great people in the world die in December? Nelson Mandela died in December, Desmond Tutu died in December, Pele died in December, Pope Benedict died in December. So there must be something, it must be like they want to make sure they see the year out before they see themselves out.
I think it's strategies are set in Jan, and they usually run up here towards the end of November. So you want to make sure you tap on the I know.
Yep.
So just before the next strat session, tell the guys download it. And that's it for me. But so obviously, right through this list, I think, a lot has happened. To say it was a tough year, I think is an understatement. But I think the upside, if I just glaze over what's been happening in the markets lately, and if I can quote one of our brokers in South Africa, most rooms are sea facing. So I'll be doing out here. And I think, if I just think back, see a lot has happened over the last couple of years, COVID, basically since the start of COVID. And Arystocast was essentially, being established through all this. We were established in 2017. The business only really started getting to full operation. 2018 funds, we started launching funds. So, I introduced you to the audience as the MD of Arystocast, but you actually have a dual role, if I have it correct.
Begrudgingly.
So, your role as MD and CIO of Arystocast, what were some of the challenges that you can share with the audience in terms of, what we've had to face over the last couple of years, starting this new business, trying to get this new brand out to the market, growing our assets under management? It couldn't have been an easy task.
Yeah, I think, to try and understand the challenges, you kind of have to understand the nature of the industry. When I try and make this explanation or make this analogy, I by no means want to say that one industry is easier than another. But if you start a shop, let's say it's a corner shop, you can literally from day one, you can start selling. You can start selling your product, whatever it may be. In asset management, the lead times are quite a bit longer. It took us a year before we got our investment management license from the regulator. It took us another year to get our unit trust license, and you can't operate as a business until you have those licenses in place. And so imagine for yourself starting a business and waiting a bit more than a year to start generating revenue. But then wait, there's more. Before you can generate the revenue, you've got to establish the product. And the product is not, it's not something that you can just put together out of thin air. You really need to think about quite a lot of technical things. So for us, it was the challenges were in the lead times that it take to get the business to, firstly, to break even, and then to get past that break even point. It took us quite a bit of a while. And you'll know as much as most other people that invest is that it's not nice asking investors for more money because you have to pay salaries, but you're not getting the income in. I think a few of the other things that were challenging for me is kind of specific to our group, in the sense that, we had branched out of Simony Storm, and Simony Storm is a stockbroker, and it was kind of a mindset change that we had to go through that also took quite a bit of a while. There's still components of it that is challenging, in the sense that we were in a stockbroking sell-side mindset, and we kind of had to convert our thinking to asset management, investment management, buy-side mindset. And it's two completely different kinds of ways of thinking about business, about performance, about clients, etc. And so I think that was also quite a bit of a challenge. For me, all in all, the experience has been exciting. It's not been a smooth line, but we have learned so much about not only investment management, but also about business. We are one of the few, I think, businesses in this industry that have had to start at zero. We had to think about what kind of departments should we have, what kind of policies should we have, what kind of capabilities and skills do we need to have, what kind of research personnel, are we going to do things in-house, how much are we going to outsource, what belief systems do we stand for. You can't just start investing. People always come to me and they're like, what should I invest in? What is like the new thing? And I'm like, you need to think about your objectives. What are your objectives? What do you believe in? And, once you have a belief, once you understand, you've articulated your belief system about investments, it's a lot easier to put a product together to match that belief system. Luckily for us, the belief system that we postulated and kind of articulated was things like, we do not believe in the efficient markets hypothesis. We do not believe in short-term investing. We don't believe necessarily that forecasting is beneficial to long-term investment returns. And the list goes on and on and on. And once we had a list of these beliefs, it was easy for us to put together a kind of philosophical standpoint of how we invest, and that then made it easy for us to have the right kind of products. And I think the performance has shown over the years, and I think, the fact that we are also all believing or kind of buying into this belief system also helps. So when we recruit, it doesn't help you recruit somebody that has a short-termist view, or somebody that believes the markets are in fact efficient, because efficient markets believers need to invest in passive products. We're an active manager. So I'm sure we can sit here for the whole day and I can tell you about all the, all the things that were challenging for us. But I think those were some of the big things that went through our minds, certainly, and that were challenges that we had to deal with.
Yeah, so I think I agree with what you just said, and our listeners unfortunately missed out on a bit of the discussion that we had just before we started recording. But I think there's something about starting things from zero. This white box that you get to fit out exactly the way you want it to look. I think you forgot the most important thing. It started all the way with what kind of furniture.
Absolutely.
So these are the kind of things that are all starting a business, but people usually don't see it if you are joining a brand with 100-year history, for instance.
Yes.
It's things like setting up our investment philosophy, drawing up our investment process from scratch. Months of work goes into, getting something like that in a state that, okay, now it's like you said, is that you can't just one day walk in and start selling a product. You need to have all these wheel ducks in a row before you can go out to the market and say, hey, listen, we have a product. We think you should invest in it. Because I think it's important for us to be comfortable in this product. And that's also why we invest our own money in product before we even go out and ask clients to invest in this product. So we need to believe in it more than anyone else out there before you can have the courage to go out and ask someone to invest.
Yeah, and I mean, we are not, I don't want to say it's sad to say, but we are not natural salespeople. I mean, we are a bunch of accountants, and
There's nothing wrong with that.
Yeah, there's nothing wrong with it. I think I still know my debits and credits fairly well. But the to really get the brand, the Aristic brand out there, is an ongoing endeavor. Every year you say, this is what I'm going to do with respect to getting the brand out there. But every year you almost kind of start over. And it's why you really need to have a long-term outlook, a long-term point of view kind of strategy when you think about building any kind of business. In fact, you need to think in terms of decades. You can't expect maximum results, instant gratification after 3 years, after 5 years. You kind of have to understand that it's going to take clients time to buy into what you have bought into over, 15 years, maybe even longer. Because it took me also a long time to understand what I believe in and what I'm comfortable with. And so we also need to give clients a chance to get used to it. We obviously need to prod them every now and again, but this is not a business about selling. At the end of the day, it's about a business that is there for long-term wealth generation.
So that's a really interesting point. I think the question I'd like to ask you is, do you think we get evaluated or judged the same as our multinational peers out there? Do you think it's, if we constantly have to go through this process of, yet another due diligence, where people come and scrutinize your business, what processes do you have in place? What is your investment philosophy? What sets you apart? Do you think us as a small guy, we kind of, I guess the question is do you think our checklist is longer than the rest of the guys out there?
I'm not really sure if our checklist is longer. I don't have any way to judge whether it in fact is. But if you say to me that it is, then I wouldn't necessarily be surprised by it. This business is ultimately, or this industry is ultimately about two things. One is confidence and the other one is trust, and the two are kind of interrelated. And confidence and trust are two things that build slowly. And when I say slowly, it's not in a matter of years, it's really in a matter of decades. And so I can understand to an extent why people want to do more extensive due diligence with Aristic than they may need to do with other organizations. But I do think with other organizations, they do go through the checklist or the checks or whatever. They might just do it over much longer cycles. Where with us, because we're so new, they're doing it a lot more regularly as they're trying to gather evidence and getting to know the people that they potentially might want to do business with. But, trust is a thing that, it's kind of like a wall of worry. You slow. But when you ultimately make the decision, I mean, it's like that in your personal life with investors. You take very long to decide what you want to invest in and where you want to invest. But once you've decided, you've basically made your mind up, and it should get easier from there. The challenge from that point onwards, obviously, is to retain that trust and to retain that confidence, because contrary to how trust and confidence builds, when they are lost in an instant, and they are almost permanently lost. And for us, relationships is a value pillar in our business. the reason for that is because you cannot maintain a sound business model in Aristec, in asset management, if you do not have a methodology for retaining trust and confidence in an ethical manner, in a manner that demonstrates integrity and putting your money where your mouth is and sticking to your promises. So we are still at the stage of gathering clients, you might say, building that trust, building that confidence. But we do have a few clients, and with those we are trying to maintain the right levels of trust and confidence.
I think a lot of these things, it's like you said, it's not something that happens overnight. I think if I didn't see it for myself, the fact that one of the clients that we are currently busy onboarding, our first meeting with them was in 2019, right?
Yep.
At the beginning of 2019.
Sounds right, yes.
It literally took us almost 4 years to win the trust of this client and finally get the mandate.
Yep.
So I think it's exactly like you just laid it up there. I think it's the lead times of these things it takes a couple of years for these things to fall into place, and even then, I think that's when the hard work actually starts. It's not, we've got the client now, and now you can forget about it and sit back and relax.
Yes.
That's where you need to pick up.
I think one thing to add to that is that we think about it in the context of stakeholders, and a client is only one component of stakeholders, and the confidence and the trust needs to be built around all the stakeholders. And I'm sure I can ask you, and I'm going to ask you. I also had to win your trust and your confidence in this business, and I had to win the trust and confidence of all the other staff, and even some of the service providers, because maybe a service provider doesn't want to give you the product if they think you can't deliver on the terms and conditions. So we have even had to make sure that the staff, the trust, that the staff kind of unconditionally trusts you, but based on sound, ethics and integrity. And that is also an ongoing thing. I mean, I'm sure for you, I actually want to know for you, which in your view was one of the biggest hurdles that you had to cross to trust in this Aristec dream.
Yeah, look, I think I also come from an audit accountant by trade, and this is something we've spoken about. When you have this massive brand with 100-year history or whatever it may be that's backing you, it's a lot easier to go out there and sell the product to the client, because they're actually buying the name, or they're buying the brand. They're actually not buying from you.
Yeah.
And joining a business like Aristec, you quickly realize it's not going to be as easy. The amount of hours you need to put in, because you actually first need to convince whoever you are selling to that they can trust you. Before you can put any brand in front of them, or before you can tell them about any product that you are selling, you first have to sell yourself. Again, coming back to the fact that we are accountants, this is not something that we do particularly well in. I think that has been one of the biggest challenges, actually going out there and getting people, as you grow up, making friends is easy. You guys all share the same interests, but when it comes to investments, I think it's a little bit different. This is people's livelihoods. This is what they need to retire one day.
Yes.
And when it comes to money, I still have to know a lot of emotions creep into the decisions that are made on a daily basis. So I think it becomes a lot more challenging when you're watching the people's money compared to, selling them something out of the store.
That's true.
But you spoke about, winning the trust of your colleagues and peers. So what I've actually done is I've I've spoken to some of the guys in the investment team, and I've asked them, if you had the opportunity to sit down with the CIO of Aristic, what questions would you want to ask him?
Well, just remember you introduced me as the MD, so I don't know. Maybe there's some invisible CIO that you need to ask those questions to.
So some of the questions that came after, I want to run through today. We'll see if time allows it for us to go through all of them. But I think we can go back to just some of the things that happened last year, all the uncertainty. We've not touched a bit on our process at Aristic, our investment process. But how in your opinion, if at all, did our process and investment style safeguard our portfolios against the backdrop that we saw last year?
Yeah, so I think at the outset, I should say, I can't remember a year in my life that there was not uncertainty. It is a bit different though that this year kind of a few rare things happened, or last year, 2022. But there is, I don't know, it's not even the word seldom. I think there's never a time when there is no uncertainty. Uncertainty is kind of a 0 to 1 spectrum event. It sometimes goes closer to 1 in terms of the extremity, and perhaps sometimes closer to 0, but it's never 0, and it's in fact never even 1. We try and separate through our investment style. We try and separate ourselves from the market, in the sense that our models and our processes that we have developed are set up in a way that your portfolio should kind of be an appropriate investment for any kind of market conditions. And so when 2022 arrived, and where market conditions were at the time, when Russia-Ukraine happened in February, when global bonds started selling off, when China went to 0, it wasn't something that kind of triggered an action in terms of now we should buy or now we should sell a particular investment item. For us, it was more about going back to our portfolio and refining our understanding of how our portfolio acts in certain periods of time. And, so we haven't done anything, to be honest, in 2022 because of certain market conditions. So our investment style has always been about what kind of assets can we put together to generate long-term returns. And irrespective of what the market thinks of those assets, it's important that we are happy with those assets in our portfolio. And so we call it risk management. I think most asset management managers call it risk management. We've got a massive risk management checklist that talks about what will happen to earnings in certain conditions, what will happen to dividends in certain conditions, how robust is the balance sheet, is there too much borrowings, too much debt, if it's in a certain sector and industry, how does it perform under certain market conditions. Because we have that kind of defense first, risk first kind of approach in our investment style, we were very defensively positioned during the bulk of 2022. And in fact, our view was that a number of markets globally were quite on the dear or expensive side. And so we were kind of positioned for that in any case, because our style is not to buy things that are expensive. And so in 2022, we were kind of positioned more in defensive way, in the sense that we were owning high quality, kind of staple type of businesses. We owned a lot of healthcare, and we had the kind of business that kind of held up in a time of uncertainty, to use that word. Because if you take let's take a simple example. healthcare is a business that operates whether Ukraine is at war or not. The consumption of beer and or alcohol and tobacco is an industry that functions whether there's a recession or not. Now, will that portfolio look the same in 2023? Who knows? But it most certainly will not be adjusted because we think in 2023 perhaps China will open up and also the market will rally. And that's the point I'm trying to make when I say, while we monitor the market, we are kind of market agnostic in the sense that our research effort is based on the fundamentals and the quality of the underlying asset that we want to invest in or that we are already invested in. We don't want to say there is something economically happening somewhere. Although we are monitoring it and looking at it as a whole in terms of how it affects our performance, it is not something that we look at. Now, the only time that it does become interesting for us is when there are times, for whatever reason, which I or you cannot really define because we are not experts in mass human psychology, that sometimes things are just suddenly cheap. And the gold star for us of investing is where you can buy a Rolls Royce for half its price. That is ultimately the golden child opportunities that we are looking for. We don't always find them, but 2022, there were a few of those kind of opportunities, and we expect that if any kind of extreme event happens next year or the year after that those are the kind of opportunities that we will be looking at. Imagine finding a Rolls Royce for half its price. That's ultimately the kind of stock, bond, commodity, cash, property, asset that we are looking for.
And just going to just touch on, earlier you spoke about the predictions and forecasts that we don't make. So for our process, was not something that we look into. Is this part of the reason why we don't do that? In that, if you look over the last 2-3 decades, almost every year there's been some sort of market event that's left people jittery and wanted to pull all their funds from equities and put it into cash. Is that kind of the reason for it, or why does the Arystocast research team not do any forecasts?
I probably wouldn't say we don't do any forecast. It is not something that drives our decision making. There's a guy named Andrew Lang. He's not alive anymore, but Andrew Lang and then Winston Churchill, they talked about statistics. So it's a bit of a funny one, so I'll share it. So they said we use statistics like drunkards use lampposts for support rather than right. So, one thing that I've come to notice, and it's a behavioral finance thing, and I don't want to get too deeply into behavioral finance because it's kind of an art. But people that do forecasting, whether it's certain economists, or market participants, or whatever, they tend to have these behavioral biases, and those behavioral biases tend to be influenced by the recent past, and they tend to kind of go forward into the recent future. And you can go and look at a lot of data on this. You would notice sometimes a lot of these people that make forecasts, when the market goes down, they forecast the next 12 to 24 months to be further down. Whereas if you actually go and look at the data going back 50 or whatever years, you'll notice that there's only 2 periods in the last 50 years where if the market is down this year, that it's also down next year. It's only happened twice in the last 50 years. So, and there's been many other years that the market has been down in the one year and then sharply up in the following year. Although, if you look at what the forecasts were doing, the forecasts were actually predicting, they were basically extrapolating the recent past. The recent past is, as you noted, the NASDAQ is down, I don't know, what is it, 30% or whatever. They're extrapolating that 30% even further down. So we have come to discover that the accuracy of forecasts, especially over 1 year or 2 years, over the short term, is highly erratic and highly inaccurate. And so while we don't do short-term forecasts, we do look at the long-term past, because I think the long-term past and that financial history that we talked about in the beginning is a fairly good predictor of the next 10 to 20 years. And so while we don't do deliberate short-term forecasting, we do have a general sense of what the next 10 plus years will look like. And so that is kind of where we direct a lot of our research effort.
Okay. So if let's just stick with 2022 for So and I want you to forget about hindsight bias. Just for a second.
Okay.
Can you were there any places that the investors could have found a hiding place last year? That looking at the performance of the real estate funds, they have held up fairly well in 2022. But where were those opportunities? Was it because not American bonds really did well last year. So were there any opportunities? And I think similarly, if you look into your crystal ball for 2023, do you see a similar picture compared to last year, or is there anything that you would do differently in your portfolio this year?
So I'll just also share a few data points and I'll try and answer your question through that. So let me just give you a sense, because it's very easy to say equities did badly last year or bonds did badly last year. But if you go one or two levels further down, you discover that there is a range of outcomes. It's not just... So let me tell you what I can see here now. So the JSE, the Johannesburg All Share Index, which is the index covering all the major stocks in South Africa, was up 4% last year. It's South African equities versus US equities as represented by the S&P 500 index, as you also mentioned in the beginning, down 18%. So to make a blanket statement like equities were down last year is accurate if you say US equities were down last year. Okay. Now, you can even go further and say, well, US equities are down, but is it all US equities that are down? And then you can get a list and it will tell you that actually it's mostly information technology equities that are down. There are actually stocks in the US that were up last year. And in South Africa, while there are stocks, a lot of businesses that were down last year, there's also a lot of businesses that were up. I'm seeing some names here. Grindrod up 123%. Oscan Consolidation Investments up 112% last year, etc., etc. While, a company like Richmond, also South African listed stock, down 4.5%. FirstRand up just under 10%. So the point I'm trying to make is, and you specifically said I got to exclude hindsight. So the point I'm trying to make is, if you had this crystal ball in the beginning of last year, there are enough opportunities in equities and bonds that would have given you a fairly good return or a fairly good outcome. Now, I'm just talking about equities there. Let's have a look at bonds. Namibian bonds are up 10% last year. That's Namibian government bonds. Developed market bonds, this is now the US and Europe and all of these places, are down 16%. So, if you were in Namibian bonds last year and you were not in offshore bonds, you would have actually had positive returns for 2022. Let's look... Positive real returns. Let's look at commodities and let's look at crypto. Commodity index as a basket is up 14% 2022. Cryptos are down 70% in 2022. But if you drill down in commodities, let's see which one is down the most. Tin, 37.4% down in 2022. Which one is up the most? It should be no surprise. Gold is up 138% last year. Now, there's no way that you could have perfectly known which assets are going to be up and which assets are going to be down. I think what helped us the most, what allowed our portfolios to hold up fairly well, is that we were fairly well positioned in the Namibian government bond space. We had no position in the global bond space, so we got that benefit. And we were also overweight those South African assets, that 4% that I mentioned in the beginning. And we weren't positioned like that because we specifically knew something that other people didn't know. We just did our analysis and we looked for what was cheap versus the quality that we wanted them to achieve. So we still went back and said, as long as it's a high quality business or a high quality asset and it's trading cheaply relative to our valuation models, we will put it in our portfolios. And so what that has caused us is that if you were invested in our, let's call it our market value funds, you would have gotten somewhere between 2 and 3% positive. Versus if you were in the NASDAQ, you would have lost 33%. Germany, you would have lost 12%. Crypto, you would have lost 70%. The list goes on and on and on.
So you touched on the government, the Namibian government bonds. And I think by the time the podcast is out, or the Aristocrat should really be circulating in the market, but without giving away too much, because you did write the article about money market instruments, and why are we still comfortable to invest in the Namibian government? What were some of the factors that we based our view on in the article?
So we had to look a bit at monetary policy. We had to look at at the banking sector, the financial sector in Namibia. But again, I'll be honest with you, Dean, that we gained most of our intel from looking at what happened in countries where governments couldn't pay the investors back. We looked at long-term financial history, and we looked at what are the kind of triggers, what caused Zimbabwe to not be able to pay back its bond investors, what caused Argentina to do it, what caused, even we went back to 1920s, what caused Germany not to be able to pay its investors back. And there were certain consistencies. They were 100% consistent across all of these stories. And we used that to then kind of superimpose it onto Namibia and say, well, where does Namibia sit in this picture? And the few things that we then kind of modeled is we looked at how much of Namibia's domestic, let's call it regulatory or institutional savings is there versus how much debt there is in the country. We looked at the peg between the Namibian dollar and the ZAR. We looked at how well or how poorly the Namibian banking sector is capitalized, and how well it would be able to cushion a shock, any kind of shock in the country. And we looked at foreign reserves. And the one thing that, and those, if you take those things in the countries that I just named, Zimbabwe, Argentina, Venezuela, Germany in the 1920s, the consistency there in what triggered is that they did not have they ran out of domestic savings. They had banks that were severely undercapitalized, and they did not have their currency, they had capital flight. Foreign investors were withdrawing money out of the country. There was capital flight. And the currency was not pegged. The currency was allowed to fluctuate, and as it weakened, it caused then hyperinflation, etc. Namibia has quite a lot of domestic savings even by developed country status. We've got a lot of domestic savings. So that was a tick for us. We've got well-capitalized banks. I mean, all of the main 4 banks in Namibia have capital ratios above 13, 14, 15%, even more when they only need to have a minimum of 10. And our foreign reserve levels have been fairly stable. Now, I'm not saying that this position will be the same next month or next year or whatever. All I'm saying is that our models and our back testing and our research is telling us at the moment, and this research gets refreshed regularly, but it's telling us at the moment that there is no reason to be concerned about any kind of default of either of our banks, either of our government instruments in the foreseeable future. And we are sticking by that view. At the end of the day, at the moment, for us, it's just about price. So if we can pick up those assets at the right price, we will buy them. But we do not think the default risk is as high as even it's being priced in the market at the moment.
And again, it goes back to, the process that we followed, finding quality instruments at the right price.
Correct.
And that's obviously, what all the process that we followed to get to the positions in our portfolios. But if we go across the border for a second, you and I going to South Africa sometime towards the end of next month. I'm not looking forward to negotiating. I have a few friends in South Africa, and it's a dire situation.
Yeah.
You get to a point where you actually have to schedule time in the diary to charge your phone because you might miss the gap. I don't know where things are heading. But obviously this has had massive implications for the stock market. If we just look at South Africa as a big mining country, mines couldn't operate at full capacity because of constraints with electricity. Eskom has obviously been struggling quite a bit. But is there light at the end of the tunnel? Do you see this thing coming to an end? What are some of the tailwinds we can look forward to South Africa? Things are back on track, or do you think it's just going to get worse from here? And what are some of the impacts that you can expect in the South African market going forward?
Yeah, it's really shocking that it has come to this, and it's I think the politics, trying to navigate through the politics of it is fairly challenging. Eskom is like those. It's what's the word? It's a household name. It's been in existence for forever. The sentiment to South Africa at the moment is extremely negative. And it's not only Eskom. Eskom is part of it. I think the politics in South Africa at the moment is part of it. The corruption and the just the bickering, internal bickering within the party. So I think all of this has kind of led to negative sentiment towards South Africa and a decrease in flows, just overall flows into South Africa. To the point that a lot of the stocks in South Africa had been trading at extremely cheap levels. If you look at the rand was, I actually interestingly saw it by accident last night. I noticed that the USD rand was trading at around 15.30 beginning of last year, and I remember it went past 18 at one point, and it's now hovering around, say, just over 17. And all of that is basically because of what's happening. There's a bit of what's happening in the US, but it's also what's happening in South Africa. It's very difficult to kind of, figure out what the outcome or where the silver lining to all of this is. Because, whenever there's a kind of a proposal being tabled, kind of, it seems like it just gets thrown out and then you don't know what's gonna happen from there. I try not to kind of make a prediction again in terms of what will happen to Eskom. But one thing I can tell you that is, if you are able to kind of step back and look past it, and if you ask yourself, should I make the assumption? You can make a few assumptions and you can say, will energy generation be a problem in South Africa for 5 years? Will it be a problem in South Africa for 10 years? Will the problem be resolved sooner? you kind of have to look at those permutations and say, is it realistic to think that this thing will not be resolved in 3 years? And kind of attach probabilities to it. My sense is that, because I also believe that everything can be bought at the right price. And I think we are already seeing it this year. The South African stock market has suddenly started going up because somebody out there is saying that at the current prices, the problems of South Africa are not so bad. Nobody is saying that these problems are so permanent that we need to sell out and never come back. And that doesn't mean that it's rosy. I'm not by any means making that statement, but what I am saying is that if you are an investor, and especially if you are a local investor, when I say local, regionally, South African, Namibia, you have to want to believe in kind of a positive outcome and a future that is favorable. I mean, South Africa is not going to go away, and there's a lot of quality businesses that are still able to operate under extreme conditions. I think that kind of tells you something about the ability for mankind to want to fix things and do better. And seeing it kind of gives me hope and confidence that 5 years from now, we are now in 2023, 2028. You almost want to say this will be a distant problem. And remember, just 5 years ago, we were worried about people going to the streets and toying and police shooting staff at Marikana. And people were extrapolating that and saying, this is going to get worse. And it just went away. And I'm not saying Eskom will go away, but I'm saying I don't believe that this will be a problem for the long term. The forces that be will find a solution. It'll take time to resolve it, but once they find a solution, the stock market will adjust for that solution quite fast. And you have to be prepared for that.
I think we shouldn't forget, China.
China's reopening.
Demand is going to start coming back online, I believe, quite strongly. So I think, these are all things that should be positive for the South African stock market going into the new year. But let's stick with China. Well, obviously, I think it was one of the hot topics last year. They have started loosening this COVID policy, zero COVID policy that they've had for quite some time. And, things are starting to reopen. But do you believe that, this is a sign that inflation can start peaking globally? Or, do you have a different view? And do you think that, this positive sentiment that everyone has towards China right now and, markets are rallying, do you think there's something that Mr. Market is missing?
Yeah, I think the market quite regularly seems to miss things. I think one thing about China is that somewhere between 10 and 15 years ago, China had no debt. Zero. Like literally, China did not have any debt, and they were pumping. And they were pumping for a long, substantial amount of time. The way that they've managed COVID does not seem to have been the right way. And at the moment, China is now just 10 to 15 years later, one of the most indebted nations in the world. That's potentially something that the market is missing. There's a bit of shadow banking that could potentially be a problem, etc. But let me speak a bit about the inflation question, because I think the one thing about inflation, the one thing about markets that I feel slightly more confident to talk about is that if inflation as we know it globally, as we have known it for the last 10 to 20 years, is not going to be the same inflation that we are now discovering and that we will become accustomed to over the next, say, 10 years or so. And it's kind of already in the making. And yes, if China opens up, potentially inflation could soften. But the one thing that you can write it on the wall, write it in your notebook. In my view, inflation is going to be a lot more volatile than it has been in the last 10 years or even 20 years. In the last 20 years, inflation has gone from, it's sort of hovered between, I'm talking about global inflation, hovered between, say, 1% and 3%. It's quite a narrow band, 1% and 2%, 2.5%. It's fairly within that 2% band that it's kind of stayed. And, it's allowed stock markets to go up substantially. It's allowed bond investors to make, astronomical returns over that period. The difference now is you could have periods where global inflation goes from, where it is now, let's say 7% or so to 3%. And just as you think you have it under control, it could spike back up again, perhaps even past 10%. And while I don't think the question should be whether if China opens up, inflation will soften. I think the question should be, how volatile is inflation going to be over the next 5 years? And I think that's what nobody's really thinking about. People will probably think that if inflation softens, let's say it goes back to the 3% or sub 3% level, the Fed has done their job and they managed to do what they said they will do. But they don't realize that inflation can happen in 3 phases, even more, in times like these that we are going through. And the triggers for a lot of this is supply chains are breaking up globally, have been breaking up since before COVID, in fact. People think it's a COVID thing. If you are able to cast your minds back to when Donald Trump was president, he was busy onshoring a lot of business in the US, and that was causing supply chain issues. He was trying to make America great again. And by doing that, he wanted to bring jobs, bring manufacturing back to the US. That was inflationary, and it was messing up with the supply chain, because even though the iPhone on the back or somewhere it says it says something like made in China actually just means it was assembled in China. But a lot of the subcomponents were manufactured in other areas like Vietnam and even Ukraine and other areas. Semiconductors came from Taiwan, etc., etc. So imagine if you take an iPhone that is kind of manufactured globally, trying to bring it back to the US and get it to be made in the US, what kind of impact on the supply chain that will have. That then led to COVID, which then worsened the supply chain. But still, we didn't see any inflation necessarily. And then we fast forward to kind of the quantitative easing, the money printing, etc. And suddenly there's so much inflation. And people are like, is it because China closed down? Is it because Russia started a war? That must be it, because that's the kind of the recent thing that's happening. But in reality, it happened when Donald Trump started fighting and bickering with Xi Jinping, with the Chinese. He started saying, we want to create more jobs in the US. And these things have a long, and this is why it's difficult to connect the dots, because these things do not happen instantly. They fester in the background and then suddenly they happen. And whatever is the most recent macro thing that's happening, people kind of want to attach it to. So the short answer to your question is, inflation will probably soften. And I'm saying probably because I don't know. But it will probably. But the real question is, how volatile will that softening and going back to it increasing again be, versus our experience of the last 20 years of it basically hovering within a 2% band. And I think that band is no longer as narrow as we have been used to it. And so we need to be prepared for it.
So what I'm hearing is the Fed obviously have their job cut out. I think the credibility is at stake. I'll come out and say it. I don't think they have the easiest job. And I think for them it's sometimes about not making a mistake rather than getting it 100% right.
Yeah.
No, you don't want to. It's about you're on the scale from 0 to 1, and you don't want to be on the side where it's 1 and you really mess things up. But you also don't mind being somewhere in the middle.
Yeah.
So with this, with what you just said about inflation, you speak a lot more volatility. What's the chance of them actually getting monetary policy right? the next meeting, I think, is I think 2 weeks away or sometime in Feb.
Yeah.
There's talk of recession, inflation is at above average levels, and one of my colleagues at office always brings up, the soft landing. So maybe that's something you can put to bed as well, and give us, in your view, are they doing the right thing, and kind of what is the expectation for the rest of the year?
Yeah. So, where can let me start it like this. So, let me tell you, even though the Fed has a difficult job, let me tell you something now, Dean. If I could invest in the Fed, I would. And I'll explain this to you. The Fed over the last 40 years, 50 years, have managed to go from kind of something in the background to one of the most prominent institutions in the United States of America. And in fact, not even only in the world. It's now, everybody knows the Fed. Some people know the Fed better than they know Taylor Swift. Some people know the Fed better than George Clooney. The way I put it is the Fed has managed to create a monopoly on money. Now, you know that monopoly, not the board game, the actual business competitive strategy, is one of the most kind of best investment opportunity we want to look at. The person that has 100% control over something that is in 100% demand generates the best earnings and returns. The Fed has a monopoly on money. They can print it when they want to. They can pull it back when they want to. They can increase the interest rate on it when they want to, and they can cut the interest rate on it when they want to. So, in an environment where the Fed has such power, and actually before I get to that, the Fed did not always have this power. There's always a kind of a balance of power between Congress and the Federal Reserve, and they're supposed to be independent bodies. And over the years, if you look at, we think that politics is just a Namibia and South Africa problem. Politics is in disarray in the US. It's in disarray in the UK. It's in disarray in Europe even. And the more politics became in disarray in the US, the Fed, in small bits and pieces, became more powerful because Congress does not have their eye on the Fed. They've got their eye on the opponent, the Democrats and the Republicans, etc., etc. And so the power of the Fed has actually gotten to a point where it is no longer a free market. You almost want to say it's no longer a free market because you've got one party, you've got 5 members, I think, that controls the global reserve currency, and they can move it wherever they want. And so if you were a forecaster and you could forecast 100% what those 5 guys are going to do, I tell you now, you'll become a millionaire. So the Fed is in a position where whatever they do will kind of drive the direction. I can kind of tell you whatever they're going to do for the next 10 months, 12 months, I can tell you where markets are going to be. Obviously, it's not easy to make that prediction, but again, I come back to history. And history tells me that after a long period of hikes, which has been happening in the last 12 months, the Fed tends to pause. And pausing means when they have a meeting, they leave the rate unchanged. And then they have another meeting, they leave the rate unchanged. And they have another meeting, they keep the rates unchanged. Now, if we start seeing that happening, our model kind of guides us to a decision. I don't think we are at that stage where we can say they are going to start cutting. They never go from hiking to cutting. They go from hiking to unchanged to maybe hiking again or cutting, but they never go hike, cut, hike. They never do that. So if you want to make a prediction for 2023, you could probably say maybe a few more hikes, probably smaller than the ones from last year because they're getting closer to the end, and then a pause. And the pause is officially known as unchanged. The Fed has left rates unchanged. If you hear that, then that's basically what I'm talking about now. And unchanged kind of leaves the market going slightly sideways to up, potentially slightly higher. But, these are not things that I can say that's going to definitely happen. We have indicators and models that help us dictate how we should be positioning. But unfortunately, we have to pay attention to the Fed because of that power that they wield over money. And that money does not just have an effect on the US. It's even got an effect on Namibia and South Africa and Europe and China and every other country in the world. And so they have just become way too powerful for you to want to trade against them. You just cannot trade against them. If you think you know a lot about cryptocurrencies, you can't trade against them. If you think you know a lot about gold or equities, you can't trade against them. You've got to trade with them.
So if I hear you correctly, and we look at the outlook for 2023, and what Aristic will be doing is two things. We're watching the Fed.
Yes.
And sticking to our process.
Sticking to our process, but also we are not trying to predict what the Fed's going to do. We do wait and see. Wait and see and stick to the process. Our models are in any case not looking at where the Fed rate is. We are looking at what was the long-term normal rate of the cost of capital. So that's basically the way we do it.
So before I leave you, I think I've taken up quite a bit of your time today. Maybe even just quickly remind our listeners again, what are the products that Aristic has available for investors out there?
Yeah, so we've got 4 funds available to the public. We've got a money market fund. It's available on some platforms. If you can speak to your financial advisor if you want to find it. So we've got the Aristic Money Market Fund, we've got the Aristic Real Return Fund, we've got the Aristic Balance Fund, and we've got the Aristic Global Opportunities Fund. Each of those funds are different based on kind of risk categories, kind of what your objectives are. And so, I can't tell you off the cuff which one you should be invested in. You really need to get a financial plan, speak to your financial advisor, and based on the outcome of that conversation, decide on which one to invest in. I would say the one that is probably the best balance for a retail individual investor would be our Real Return Fund, because it helps you cushion the effects of inflation, which is clearly going to be an issue over the next number of years. The nice thing about the Real Return Fund is that it kind of diversifies against global geographies, global currencies, different asset classes, and it's kind of positioned to cushion you against any extreme events. It did do 2.9% in 2022. In absolute terms, it's not a great return, but if you look at it relatively to other markets, if you were invested in any of the global other markets, you would have had a really, really red and horrible year, ranging from 10% minus to 32.5% minus, where you could have had a 3%, let's say a 3% return in our Real Return Fund. So it's really the fund that I think is the best suited for an investor. It's got everything in there for you, so you don't have to think much about it other than opening the account and starting to invest. If you want a bit more international exposure, international equities or stocks, you need to look at the Aristic Global Opportunities Fund. It did do a negative return last year. It did minus 5.1%. But again, that compares against the index, which did minus 12%, NASDAQ, which did minus 32.5%. S&P 500 is just it just looks bad when I look down the sheet. So it's kind of well positioned for strong returns in 2023 and beyond.
And I think, like you mentioned as a small disclaimer, please do speak to your financial.
Absolutely.
But Purvance, thank you very much for your time today. It was an honor sitting down with the MD / is this that?
Apparently there is. I've now been convinced this morning to retain my deal position.
Thank you for your time, and I look forward to the next episode.
Oh, thanks a lot, Dean. I think I really appreciate this. Thanks for your insightful questions, and please relay my message to your team for the very difficult questions they asked. I think we need a lot of those. But yeah, I don't think anybody should be concerned about the future. But it is important that you deal with your finances as deliberately as you deal with every other important aspect of your life. Your health is important, your family is important, your finances are important. Forget about the root of all evil. Money is as important to the comfortable existence of you as an individual as any of the other things. So it's very important to go and speak to your financial advisor. But thanks a lot for this conversation. Good evening.